Namaste to all. A very warm welcome to yet another session. Today, the topic is about income from house property. So, I'll start sharing my screen basically. Before that, I just explain what is a house property. What do you mean by house property? So, what do you mean by a house? Any land where four walls are there and a roof is there on those four walls. That is called as a house, correct? So then what do you mean by vacant site? Is it considered as house property? No, the vacant site is not considered as a house property. Only a land consisting of four walls and a roof is considered as a house property. So let me share my screen and start discussing about house property, income from house property. Yes. So here we are now in the introduction section. So where are we? Income from house property in income tax computation module basically. So I'm starting with introduction section. So in the introduction section, you can see the definition of house property. As I told you earlier, what is house property? It simply refers to a building or a land that is used for either residential purpose or commercial purpose. What do you mean by residential purpose? As a family stay in that particular house, it is called a residential purpose. And we are any people doing any commercial activities like a company is being registered or any company is there in that particular place, any business activities are going on, then it is called commercial purpose. So basically, house property means any land surrounded by a wall having a roof or not, and land appertaining to a building. What do you mean by this land appertaining to a building? So many of you know about this, but some people might not know what is this land appertaining. So it is very simple. So if you're having a home with some garden or some empty space in front of your house, that land, vacant land would be there, right? I told you the vacant land is not a house property. But if there is a house property, if there is a building, and in apart from that building, attached to that building, any land is there, vacant land like a garden is there, that is also considered as a house property. Only the vacant site like plots, those are not considered as a house property, but any building or having this vacant land supporting to that, it is called as a income from house property. So then we come to the different types of house property. What are the different types of house property? There are two different types of house property. One is self-occupied property, another one is let-out property. What do you mean by self-occupied and let-out? Very simple. The name itself suggests self-occupied means we being having a house property and we are occupying that particular property. That is called as a self-occupied property. So do we get rent from that self-occupied property? Obviously no. We don't pay rent to ourselves, right? We only get rental income from let out property. What do you mean by let out? If I am having a home, I am giving my home as a let out to another person, naming X. That X will give me the rent. That would become my rental income. So I need to show it under income from house property. Understood, right? You can see the remaining things here. Income from house property refers to the rental income earned by an individual or an entity from letting out a residential or commercial property they own. Obviously, so if I am letting out my property, house property to a normal family, it is called residential property letting out. If I am giving it to a company or any business activities, that is called a commercial property let out. What is the difference? There is no difference. Both the income is taxed under income from house property. So now, what is the basis of charge? So as per Income Tax Act 1961, Section 22 deals with the basis of charge. So the process of computation of income. So till now we are talking about income from house property. So the rental income, how much we are receiving, that would be considered as income. So now how this income would be charged under income tax. So that will be defined in section 22. So the process of computation of income under head income from house property starts with determination of annual value of the property. What do you mean by annual value? Very simple. How much rent you are receiving per month multiplied by 12 is called your annual value. There are some conditions to it. I'll explain. So before that, you can see there are some conditions for chargeability. What are those conditions for chargeability? Property should consist of any building or land appertaining thereto. As I told you, a vacant land cannot be taxed under income from house property. Any income received under like received from a vacant land letting out, you are not supposed to tax under income from house property. It should be taxed in other sources. If it is a business purpose, it will be charged under PGBP. That's a different story. But the basic condition here is to charge income under house property, the property should be consisting of any building or land appertaining thereto. That's the first condition. What is the second condition? Assessee must be the owner of the property. So sometimes what happens? I am the assessee who is having so much of income, but the land or the house property is not in my name. It is in my father's name. I cannot claim his rent. Like I cannot show rental income in my name. He needs to show. My father needs to show in his return of income from house property. I cannot show it under my statement of income stating that so the income from house property. So whoever is the assessee receiving the amount, whoever the house property is registered in that particular person's name, that person needs to show his income from house property under the return of income. So the assessee must be the owner of the property basically. Then use of property. What do you mean by use of property? As I told you, either it should be self-occupied or letting out, right? So the property should be used for the commercial or residential purposes. Okay, it should be used for any commercial and residential purposes. Then only it would be charged under income from house property. So if I come down, you can see an MCQ is there here. What is this MCQ? They're asking us vacant site lease rent is taxable as. So till now I was telling about this only. So you can answer this question. So vacant site lease rent is taxable as basically it is not income from house property because it is a vacant land. There is no land or building appertaining to that vacant site. So that's why it is not an income from house property. So what is this income? Income from other sources or business income as the case may be. So I'm clicking on the correct option. See, oh, I earned some Fincy coins. So I earned some Fincy coins. That's great. And you can see the answer here. As the conditions for taxability under the house property is not satisfied, thus taxability under house property shall not arise. So these are the three conditions for chargeability. I'm repeating again, what are the three conditions for chargeability? Property should consist of any building or land appertaining thereto. Assessee must be the owner of the property. Use of the property either for commercial or residential purpose. So now, till now we spoke about what is house property, what is income from house property, what are the conditions for taxing income from house property. So now let us understand method of computation of income from house property. What is the method? As I told you earlier, annual value. How to compute annual value? Rent received multiplied by 12 months. That would be your annual value. That annual value is nothing but gross annual value. But this gross annual value cannot be determined only with this thing. There is some extra steps to determine gross annual value. I'll let you know after some time. So I'm just showing you some statement like one table, how exactly the method of computation would be done. So gross annual value minus municipal taxes paid. What is this municipal taxes? So basically the state government will charge some taxes on the houses every year. Okay, that would be paid by the owner. So if the municipal taxes are being paid by the owner, those municipal taxes has to be deducted from gross annual value. Why they are deducting here? Because if you compute income from house property, on that income, ultimately you are going to pay some tax to the government. So before estimating the income from house property, you have already paid some amount of tax to the government in whatever form. So municipal taxes you have already paid, right? To the government, to the state government, you have already paid. So the taxes already paid should be deducted, and that should be paid by the owner. Otherwise, it cannot, like for example, what happens? Sometimes the tenant might be paying those municipal taxes in the name of owner, and tenant sometimes what happens, tenant will not even get the refund of money from the owner. In those circumstances, the owner cannot claim as the deduction. So this municipal taxes, whatever the owner is paying to the government, he can take as the deduction. And from gross annual value, if you minus municipal taxes, you arrive at the net annual value. What is this net annual value? Gross minus municipal taxes. So after that, there are some standard deductions under section 24. What are those standard deductions under section 24? That is 30% of NAV. So government is telling, boss, if your income is, let us suppose 1 lakh rupees is your income, gross annual value, and you have paid some 10,000 rupees as municipal taxes, 90,000 would be your net annual value. Government is not going to charge taxes on 90,000. They tell, okay, boss, you have arrived some income 90,000, 30,000 flat deduction I give you. You pay only 70% of the annual value. So that means only on the 70% of your income from house property would be chargeable to taxes. Understood? So 30% of net annual value means how much? So 90,000 into 30%. That comes around 27,000. So 90,000 minus 27,000. That comes how much? 63,000. So after that, if still any interest on borrowed capital is there, which means sometimes you might have taken loan for purchasing that house property from a bank. So for that EMI you would have been paid. In that EMI, interest portion would be there. Interest portion, principal portion. In only to the extent of interest portion paid on the borrowed capital is allowed as a deduction here under section 24. And what about principal portion? That will come under section 80C. And this is the basic idea of method of computation. So, and you can see the points to remember. So what and all till now we have just seen, it is just a recap. You can go through it. Next. So once I go to the next section is annual value. So determination of annual value. What is this determination of annual value? So basically this annual value, I already told you, you need to compute gross annual value. So how to compute this gross annual value? How to compute this gross annual value? So I'll just explain it with a image so that it would be easy for you to understand. So how to do this? So you can see the computation of gross annual value is very simple. Two things you need to take: municipal value or fair rental value. What is this municipal value? The municipal value is the value which has been determined by the municipal authorities for levying municipal taxes on house property. Okay. So municipal value is nothing but value determined by the municipal authorities. Then what is fair rental value? So in a locality, what would be the amount of rent that property will fetch? The fair rental value. That is called fair rental value. So municipal value or fair rental value, whichever is higher, would be taken. Okay. First step. Step 1, municipal value or fair rental value, whichever is higher, or standard rent. What is the standard rent again? The standard rent is nothing but there is a Rent Control Act. As per the Rent Control Act, the act will state for this type of property, this should be the standard rent. So standard rent or the value which has been taken higher of municipal value or fair rental value. So step 1, municipal value or fair rental value, FRV, whichever is higher, that value you will take as second step. In second step, this whichever is higher value or standard rent. So whichever is higher or standard rent, out of these two, the lower amount is considered as expected rent. So you arrive at expected rent by calculating the amount whichever is higher of municipal value or fair rental value or standard rent. That is called expected rent. So now this expected rent or actual rent received, whichever is higher. Obviously, actual rent received only would be higher. So as I told you earlier, the rent received multiplied by 12 is nothing but your gross annual value. But sometimes what intelligent people will do to not show the full income, like for example, they might have received some 20,000 rupees as rent. But what they will do to escape from the taxes, they show only 10,000 per month. So government has came with all these things. So for example, what is the municipal value, what is the standard rent in that particular area, what is the fair rental value, all these things you need to consider. And then if it is more than 10,000, then obviously you need to take the expected rent, correct? So actual rent received or expected rent, whichever is higher value you need to take. If actual rent received only 10,000 per month, but expected rent is 15,000 per month, example, then what happens? You are bound to take expected rent. So that is why government has came with all these things. So usually people are very smart. So government is way too smarter than people. So that is why all these laws has been came. So now you can say very simple, actual rent received multiplied by 12 months would be your gross annual value in majority of the situations. But if an assessee is trying to escape from taxes and wants to show some lesser income, then these calculations are required usually. And then let us understand these calculations with a small example. So they're telling in the example, municipal value is 8,64,000. This is per annum, not per month. Fair rental value is 10 lakh 80. Standard rent is 9 lakh 60. Actual rent is 12 lakh, which is 1 lakh per month. Okay, fine. So now using this table, we can solve this, right? So municipal value or fair rental value. Municipal is 864, fair rental value is 10 lakh 80, whichever is higher. So obviously 10 lakh 80,000 is higher. So here we write 10 lakh 80 or standard rent. Standard rent is how much? 9 lakh 60. 10 lakh 80 or 9 lakh 60, whichever is lower. The expected rent here is 9 lakh 60. So 9 lakh 60 or actual rent received, that is 12 lakhs. So obviously actual rent is higher. So gross annual value would be 12 lakhs. So you see gross annual value is 12 lakhs. It is very simple to calculate the gross annual value. So now there is one practice question here. So in this practice question, they are telling Amar owns 5 houses in India, which are all let out. So he is letting out all his 5 houses. So compute gross annual value, municipal value, fair rental value, standard rent, actual rent received. So this is per month. So using this table, it is easy for you to do it. You can practice by yourself. Please do practice. You can see municipal value, fair rental value, higher of these two and standard rent, lower of these two would be expected rent, and this expected rent and what actual rent received, whichever is higher. So 90 or 72, 90, 60 or 72, 72, 58 or 60, 60. So 25 or 30, 30, 78 or 72, 78. So sometimes you can see here, basically actual rent received sometimes is lesser than the expected rent, correct? So this Amar wants to show the amount which is less than the expected rent. That is not possible. So that is why the gross annual value should be taken higher of expected rent and actual rent received. So this is how you calculate gross annual value. I hope it is clear for everyone. So next we move to the one MCQ they are asking. Mr. Rajiv purchased a property on 31st August 2022. Fine. Municipal value is 2 lakh 40. Fair value is 25,000. Standard rent is 2 lakh 30 per annum. Compute expected rent. So now don't directly calculate 2,40,000 and fair rental value. So here they're telling he purchased the property on 31st August. So April, May, June, July, August, 5 months gone. Only 7 months is remaining. So for the 7 months, you need to calculate the expected rent. I hope you understood and you can do this MCQ by yourself. Next, I move to the next thing that is called actual rent when the property is vacant. What do you mean by this? So sometimes what happens? You're trying to letting out your property, like you kept to let board, but nobody is coming to stay in your house. Sometimes it happens, right? During Corona time or doing so many COVID times, or not only COVID times, like majority of the times you cannot even get people to come and stay in your house sometimes. So then what happens? That to let board would be there. That means the house is vacant. You are not receiving any income. So if the property is ready to be let out, but you could not actually get the income from that particular house, then what happens? The gross annual value would be nil. Obviously, right? If you receive the money, then only it is considered as income. If you're not even receiving money, that is not considered as income, and therefore gross annual value shall be nil. So now annual value of the property which is partly let out and partly self-occupied. Oh, this is very interesting again. So what do you mean by partly let out, partly self-occupied? So for example, in a house, there are some, like for example, ground floor, first floor. In ground floor, I am staying, first floor I gave it for let out. Or for example, only ground floor is there. In that ground floor, some 5 rooms are there. 3 rooms are self-occupied, 2 rooms are let out. So then how do you determine the annual value of the property? So very simple. Property used for residential purpose could not be occupied owing to employment at any other place. The annual value shall be nil. Obviously, self-occupied property, the annual value will always be nil. And what about the let out? The let out units, the annual value shall be determined as per section 23(1). So gross annual value is equal to ER means expected rent or AR actual rent. So in this table we have already learned. So this is expected rent or actual rent, whichever is higher would be your gross annual value. So that is what they are telling again. So just let us do some quick recap of what and all things we have learned now. So gross annual value of the property shall be deemed to be like how it has to be calculated. If the house is let out throughout previous year, then expected rent or actual rent, whichever is higher. If the house is let out and was vacant whole or part of the year, then what happens? Actual rent is less than expected rent. Owing to such vacancy, actual rent received would be your gross annual value. In any another cases, expected rent or actual rent, whichever is higher. Always that would be the case. Expected rent or actual rent received, whichever is higher. And if house is let out in part of the year and was occupied for remaining part of the year, which means in 12 months period, 6 months I let out to some party and another 6 months I only stayed in that particular house. Then only to the extent of 6 months it is calculated. The gross annual value would be calculated. I hope it is clear about gross annual value, how to determine the annual value. So let us move to the next section that is called deductions. What are these deductions? As I told you earlier in the method of computation statement, gross annual value minus municipal taxes paid. You get net annual value minus standard deduction 20 under section 24A minus interest on borrowed capital 24B. We would be talking about those deductions minus amounts, how those minus amounts will be done under section 24 basically. So deductions under house property, municipal taxes paid, standard deduction and interest on borrowed capital. So let us see what is this municipal taxes paid. As I told you earlier, it is very simple. The municipal taxes levied by any local authority in respect of a house property is allowed as a deduction. the conditions, if the taxes are borne by the owner and the taxes are actually paid by him during the year, obviously. So then net annual value, how it is determined? Gross minus municipal. So net value is equal to gross annual value minus municipal taxes paid. It is only for the lettered property. Then what about self-occupied property? For self-occupied property, the gross annual value is nil. So therefore, you cannot claim municipal taxes paid. Which means even though for a self-occupied property, if you are trying to claim the deduction, it is not possible because the gross annual value is only nil. If your income is only zero, why do you want to claim the taxes amount? That is how it is. Then we come to the standard deduction. As I told you earlier, 30% of NAV, very simple. Whatever net annual value will come, straight away 30% is deducted, and on 70% you need to pay taxes. So now, most important thing in the entire house property chapter is this interest on home loan for the property. So usually people come for us for the tax planning purpose. How to do tax planning? So majority of the tax planning happens using this interest deduction. Some people really buy the house and claim the interest. Some people just claim the interest amount without even taking the interest on loan for the property, and they end up getting notices from the income tax department. So it all depends upon the perspective of the people, and you need to follow the rules actually as per the Income Tax Act. So now let us understand something. What is this deduction of interest on home loan for the house property? Two things would be there. As I told you earlier, self-occupied property, rented out, let out property. So situation one, if the house is self-occupied. So if the house is self-occupied, then what happens? There is this thing called gross annual value, which is zero. So obviously there is no income from the self-occupied property. But still, so basically gross annual value is zero and net annual value is also zero. That standard deduction 30% on zero is also zero. But only thing you can claim as a deduction for the self-occupied property is interest paid on housing loan. How much interest? So there is a limit, 2 lakh rupees per annum for each assessee. So let me tell you an example. So I took a house on a loan and I am paying 3 lakhs rupees as interest for that particular house property. But I cannot, and I am staying in that particular house. It is a self-occupied. What happens? I can claim only up to 2 lakhs. I cannot claim 3 lakhs because the income tax is restricting me to take only 2 lakhs per annum, even though I have paid 3 lakhs. Okay. But here I can do one small tax planning. If my house is registered in the joint name, either I took the house like in a joint name with my wife or with my mother or father. If it is in the joint name, what happens? I get 1.5 lakh, like 3 lakhs, right? 50-50. So if the house property is joint ownership, then the 50-50 thing will come. So out of 3 lakh, 1.5 lakh would be coming for me, and another 1.5 lakh would be going to my wife. So then what happens? That 1.5 lakh I can claim as a deduction under my income tax return, and another 1.5 lakh benefit she also can claim. So usually, if any person is paying 4 lakhs rupees as an interest for the interest on housing loan, it is suggestible that the property is under the joint ownership of 2 members, so that that proportionate amount will get as a deduction. So 2 lakh only is the maximum amount for each assessee, which means for if it is a joint ownership, then 2 lakhs each, 2 lakhs each, 4 lakh you can claim. So I remind you again, this is only under the old scheme. Under new, as of now, under new scheme 115 BSC, these are all not applicable. If you are opting out from the new scheme and availing old scheme of regime, then only these deductions and all those things will apply, mind you. Okay, so that is self-occupied. And next one is called interest on borrowed funds. So when the house is let out, so even though when the house is let out, now another important thing comes here. This 2 lakh limit I told you, right? This 2 lakh limit will not be there. You can claim how much ever interest you are being paid for that particular house. But there is one condition here basically. What is that condition? That deduction of amount should not be more than the income from that house property. Simply, I'll tell you one small example. If it is a let out property, there would be a net annual value, right? After net annual value, you minus 30% of deductions. So after 30% of deduction from net annual value, if that amount is coming to some around 6 lakhs, let us assume. If that amount is 6 lakhs, interest paid on the housing loan by you is 4 lakhs. Then the whole 4 lakhs is allowed as a deduction. Example. Now another case. In that 6 lakhs, you have now that value is coming 6 lakhs. The interest paid on housing loan is 7 lakhs. You cannot claim 7 lakhs. You can claim only 6 lakhs. Then what about that balance 1 lakh? That balance 1 lakh will be carried forward to the next 8 assessment years, and that balance 1 lakh can be set off against next year income. Something crazy, right? So you need to understand these small things. I'll explain again. I'll just repeat it again. Don't worry. So if it is a let out property, how much ever interest paid, full amount of interest is allowed as a deduction, subject to a condition. What is that condition? That condition is, in this year, how much ever interest is there, how much ever income from let out property is there, to that extent you can actually set off. That is called intra-head set off. Okay, intra-head set off can be done unlimited. After that, balance amount would be there, right? That balance extra amount should be carried forward to next years, so that that will be set off in the next year's income. Very simple. So this is interest portion on self-occupied property and let out property under section 24. Then what about pre-construction interest? This pre-construction interest is nothing but, for example, if I took the loan on to construct a house on a land, okay, so till the time I took the loan and I completed my this house property, like construction of the house property, then also I need to pay interest and principal amount to the bank, right? If I took some 10 lakhs rupees loan, if every month I need to pay, for example, 50,000 as a EMI to the bank, that bank people will not wait for me to construct the house, right? They will every month they will send me the notice stating that please pay the amount, or they will directly deduct from my bank account. Correct? So the amount from the date of loan taken to the date of construction of the house, how much ever is that period is there, in those periods how much amount I have paid as a loan to the bank as an interest, basically principal portion will not be covered, only interest portion, how much I have paid, that amount I can take as a deduction under section 24. Again there is a limit of 2 lakh every year, but that how much ever interest portion would come, that divided by 5, which means 5 equal installments. So I'll tell you one small example. If I took the loan on 25th June 2023, okay, so if construction of the house property is completed in the financial year 23-24, here the example they are telling, on 25th June 2023, you can claim 1/5 of interest paid up to till 31st March 2023, which means if my house property construction is completed on 25th June 2023, I can claim 1/5 of interest paid till 31st March 2023. If till 31st March 2023, I have paid 5 lakhs of interest, I cannot claim 5 lakhs in that year. I can claim only 5 lakhs divided by 5, that is 1 lakh in that particular year. Next year again 1 lakh, after that year again 1 lakh. In 5 equal installments, this pre-construction interest you can deduct actually from the income from house property. So let us understand in a table what exactly is this. Let us bifurcate the things in a simple terminology. Interest on borrowed capital table maximum limits. So if the interest paid on a house loan, self-occupied property or let-out property, deduction is allowed for the interest paid on the principal amount borrowed for the construction or purchase or improvement of the property. So obviously for both self-occupied and let-out, interest paid is allowed. But there is a maximum deduction. What is that maximum deduction clause telling? That maximum deduction clause is telling for a self-occupied property, it is maximum up to 2 lakhs per year for self-occupied property. If it is a let-out property, intra-head income. What do you mean by intra-head? If there is income from house property from a let-out property, then there is no limit. How much ever income is there, that will be set off, minus, and only balance will be carried forward. And if it is inter-head, which means there is in the let-out property, you are getting some 3 lakhs rupees as loss. That 3 lakhs rupees loss cannot be set off against income from salary or any other heads. Only to the extent of 2 lakhs it can be set off. Inter-head it is only 2 lakhs. Balance it will be carried forward to next 8 assessment years. And what about pre-construction interest? Allowed in 5 equal installments starting from completion year. That is for the self-occupied property. Then what about let-out property? It is allowed in full for the year paid. So this is the overall thing we have seen till now about interest on borrowed capital. So you can see here a table, computation of income under the house property. As I discussed earlier, gross annual value less municipal taxes, you will get net annual value, and less standard deduction and less interest on housing loan, you will get up income from house property. This income from house property is one of the head which is chargeable as income and added to the gross total income. On gross total income, the taxes will be calculated. So this is how we completed the income from house property. If you still have any doubts, please reply down in the comment section. We're happy to help you. Thank you all for joining the sessions. Thank you. Dhanyawadaha.